All right, if you're here, you already felt it. You saw silver screaming higher, headlines going vertical, and then, out of nowhere, about 15% just vanished in hours. I'm talking tens of dollars gone before most people even refreshed their charts. This wasn't a slow bleed. This was a trapdoor. And here's the thing, you were probably told this was just volatility. It wasn't. The real trigger hit fast, it hit hard, and it exposed something fragile underneath the entire move. Stay with me, because I'm going to show you exactly what just happened, why it matters right now, and how you can recognize this pattern the next time it shows up before the damage is done. Before I explain what caused this, let me teach you something most people never really internalize. Markets don't move on opinions. They move on positioning. They move on who's already in, how leveraged they are, and how quickly they're forced to react when conditions shift. Think of price like a crowded elevator going straight up. Everyone feels great while it's climbing. But the moment the cable jerks, even a little, people panic, hit buttons, and suddenly the move down is faster than the ride up ever was. That's what you need to understand about parabolic rallies. They're not strong because they're stable. They're strong because they're fragile. When leverage stacks on leverage, when momentum funds pile in alongside retail traders who've never touched the market before, you don't get a foundation. You get a tower. And towers fall harder than they rise. So, what does that tell us? It tells us that the violent moves, the ones that feel catastrophic, they're usually not fundamental breakdowns. They're mechanical. They're about who got caught, how much they borrowed, and how fast they had to get out. If this is making sense, drop a comment below and let me know you're following. Because this next part connects everything. Now here's what's actually happening. Let me break down the sequence in real time. Silver didn't just rise, it exploded. We're talking about a move that took it from the low hundreds to north of 130 in days. Momentum funds piled in, retail chased, options got stretched, leverage stacked on top of leverage. And here's what most people don't realize. When you see that kind of move, it's not just buyers pushing price up. It's also dealers hedging, algorithms reacting, and leverage creating leverage. Every call option that goes in the money forces market makers to buy more silver to hedge their exposure. That buying pushes the price higher, which puts more options in the money, which forces more buying. You see the loop? It's a feedback mechanism, and it works beautifully on the way up, until it doesn't. At the same time, silver was being sold as a safe haven, which sounds comforting until you realize safe havens only work when the currency side of the equation cooperates. Then, the US dollar surged, fast. That surge came from renewed uncertainty around Federal Reserve leadership, confusion, speculation, and suddenly a bid under the dollar that wasn't there days earlier. When people start questioning who's running the Fed, when there's even a hint of policy uncertainty at the central bank level, money rushes into dollars. It's reflex. It's muscle memory from decades of crisis playbooks. So when the dollar ripped higher, silver didn't just drift lower. It got punched. The first drop triggered stops. Those stops triggered margin calls. Margin calls forced liquidation. That liquidation pushed price into thin air, where there were no buyers waiting. That's the air pocket. That's why it felt violent. You had leveraged longs getting stopped out. You had dealers reversing their hedges. You had algorithms reading the momentum shift and piling on the sell side. Everything that amplified the move up reversed in minutes and amplified the move down. And here's the part that should make you nervous if you weren't watching closely. Nothing fundamentally broke in silver itself. This was mechanical. Crowded trade meets currency shock. That's the cascade. There was no sudden discovery of massive new supply. There was no collapse in industrial demand. The mines didn't suddenly triple their output. What happened was purely about positioning, leverage, and the dollar. When you understand that, the move stops being mysterious. It becomes predictable, not in timing, but in structure. Now let me show you what most people are missing. When you see a move like this, the temptation is to call it manipulation or chaos. And look, I get it. When you watch your position get cut in half before you can even process what's happening, it feels personal. It feels rigged. But when you zoom out, this is the exact same playbook we've seen before. In 2011, silver went parabolic. I'm talking about a move from the low 30s to nearly $50 in weeks. Sentiment went euphoric. People were calling for $100, $200. Leverage went insane. And then a sharp correction wiped out weak hands before the market stabilized. It wasn't the end of the silver story. It was the end of that particular leveraged wave. The metal corrected, consolidated, and the real believers stuck around. In 2020, after the pandemic shock, silver surged from the mid-teens to nearly $30 in months. It corrected brutally in September of that year, dropping from 29 to 22 in days. And then it rebuilt its base before moving again. Every time this has happened, the sell-off felt like the end. Every time, the headlines screamed collapse. And every time, it turned out to be an inflection point, not a terminal event. What do these moments have in common? Parabolic advance, extreme leverage, sudden currency or policy shock, mechanical liquidation, then stabilization, then reassessment. The larger story isn't about price collapsing into oblivion. It's about excess being burned off. It's about leverage getting flushed. It's about markets reminding everyone that speed cuts both ways. Zoom out and you see that supply didn't magically loosen. Industrial demand didn't vanish overnight. The story didn't die. It just got reset. And every single time this pattern has played out in the past, the question wasn't whether the asset would recover. The question was who would still be holding when it did. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this keep falling? Absolutely. Could the dollar stay strong longer than people expect? Yes. Could we see silver test lower levels before it finds a real base? It's possible. Markets don't owe you a bounce just because something dropped fast. And here's the thing about manipulation narratives. They distract you from what you can actually control. You can't control headlines. You can't control whether some fund manager decides to dump a massive position. You can't control central bank drama. But you can control how you interpret positioning, leverage, and momentum. That's where the edge lives. That's where you separate yourself from the crowd that just reacts emotionally to every spike and dip. There are probably 3 types of people watching this right now. The first is the person who chased near the highs and feels sick to their stomach. Maybe you bought at 120, 125, thinking this was just getting started. Maybe you leveraged up because everyone was saying silver was going to the moon. If that's you, let me say this. You're not stupid. You're not uniquely unlucky. You just learned painfully how momentum trades behave when they unwind. Your job now isn't revenge trading. It's not doubling down to get even. It's survival. Reduce risk. Regain clarity. Take the lesson. The market just taught you something expensive, and if you internalize it, it'll save you 10 times that amount in the future. The second type is the long-term believer who didn't sell anything and feels confused more than scared. You've been holding silver for years maybe. You believe in the fundamental case. You see the debt. You see the printing. You see the industrial demand dynamics. And you're watching this thinking, did I miss something? Is the thesis broken? For you, this is about patience and perspective. Corrections like this don't invalidate a thesis. They test your ability to stick to it without emotion. If you bought silver because you believe in the long-term structural case, nothing about this move changes that case unless you let fear override analysis. The third type is the observer, the one who didn't touch it and wants to know what to do next. You watched it run, you thought about getting in, you hesitated, and now you're wondering if this is the opportunity or the warning. This is where you study. This is where you get your education without paying tuition in losses. Watch how price reacts after forced selling ends. Watch volume. Watch the dollar. Watch whether silver finds support or just keeps bleeding. This is how you get ahead of the crowd next time instead of chasing it. This is how you learn to read the setup before it becomes obvious to everyone else. So here's what I want you to answer in the comments. Which type are you? And what's your biggest question right now? Because I read every single one, and your questions shape what I cover next. Here's where I stand. I'm not panicking, and I'm not chasing. I'm watching. Let me tell you what I'm personally watching. First, I'm watching the US dollar. Does it hold this strength, or does it fade back as the Fed uncertainty gets resolved? If the dollar pulls back, that removes the pressure that triggered this cascade. If it keeps climbing, silver's going to have a hard time stabilizing. Second, I'm watching silver's ability to hold support levels after the liquidation phase ends. Is there real buying interest coming in at lower levels, or is this just dead cat bounces from shorts covering? Third, I'm monitoring sentiment. Are people fearful, or are they still euphoric? Fear creates opportunity. Euphoria creates risk. Based on my analysis, this move was mechanical, not emotional. It was technical, not fundamental. The fundamental picture hasn't changed. Supply is still tight. Industrial demand is still growing. Central banks are still dealing with debt they can't mathematically repay without debasing currency. Those things didn't change because silver dropped 15% in a day. What changed was who was holding it, how they were holding it, and what forced them to let go. If history rhymes and silver stabilizes here, absorbs the selling, and starts building a base, the move that follows could be more powerful than what we just saw. Not because of hype, because the weak hands are gone, the leverage is out, and the people left holding are the ones who aren't forced sellers. That's when real moves start, not when everyone's in, when only the believers are left. I'm not a financial advisor. This is not financial advice. Do your own research. Make your own decisions. But if you made it this far, you're thinking critically, and that mentality will serve you well. That's the mentality that survives these moments and profits from what comes next. If this helped you make sense of what just happened, share it with someone who needs to see it. Hit subscribe if you want to stay ahead of these moves instead of getting caught in them. And drop your thoughts in the comments. Think critically. Verify what you hear. And make decisions based on structure, not noise. Stay sharp out there.